let's say you buy it on January the 1st, right? And let's say that by April the 1st, you bought it at 90. Let's say by April the 1st, you're done. And that thing you might even have an appraisal at 120 on it.
Mm-hmm.
Because you're within that 6 months, nobody cares about that appraisal.
From the network studios inside Michigan Investment Title, this is episode 16 of the Michigan Investor Network podcast, hashtag the network, brought to you by flipnerd.com.
All right, everybody, we are back with another Michigan Real Estate Investor Network podcast, hashtag the network. My name is Dylan Tanaka. I'm here with my old/new/good friend, Brian Mutter. He is a mortgage expert. I've got Paul Beets, MC Paul Beets, to my left. And then straight across, we have Frank the Karate Kid Alcini, which is true. You'll all see in one of our promo videos. Frank's Italian, and so is Daniel LaRusso. So it kind of fits.
Yeah, that does work out.
Yeah. So how are we doing today, guys?
I'm doing really great.
Excellent.
Beautiful.
I'm doing great on this sunny summer day.
Yeah, I'm excited to be here. Usually I'm behind the, I don't know what you call it over there, the board and the computer and all that stuff. So today they let me loose, and
Dylan's
I get to be part of the
Gray.
podcast. Sometimes I am.
Sometimes.
So I don't know what we're talking about today, but it's another roundtable episode. We've got four semi-smart real estate investors, or those of us who are service providers that help us as real estate investors do what we do. So I think, this is the first time Brian's been on the podcast with us. So why don't you tell us a little bit about yourself, Brian, and your business, how long you've been involved in real estate?
Sure. So I got in the mortgage business at the end of 2014. As a loan officer, and it was a disaster. I was that guy. I was on the job for a few weeks before I even knew what a mortgage was, and it was a humbling experience. So again, it was a sales role, so it was 100% commission, and this was like it was a sort of high pressure sales kind of environment. And knowing nothing about what I was selling or what I was doing or anything about sales, it was, like I said, it was a bit of a disaster. So, that was, looking back, it was a bit of an old school sales mentality. They'd have you grind on the phones for at least 4 hours a day. And it was really just the sales technique of knocking them on the head until they submit, which just wasn't a good fit for me personality-wise. So thankfully for me, those same guys who owned that mortgage company owned a title company. One day they called me in. They said, "Hey, Brian, how you doing?" And they could read the look on my face.
And what year was this again?
End of 2004. So by now it's probably like late 2005.
So still pre-foreclosure days.
Yes. This was if you had a pulse, you can get a mortgage. It didn't matter what credit score. It didn't matter if showing pay stubs or W-2s. So I went from there. They took mercy on me and they said, "Listen, we have a title company. Why don't you go over there, sit behind the desk, and process HUDs?" That's how long ago it was. It was a HUD closing statement. So I did that for about a year, and that seemed more suited to my DNA, if you will, just to be on the process/operation side, because based on my experience as a sales guy, I really believed I'm not a sales guy. You look around the room and there are people that are just, they're no different than you. They probably have a hard time tying their shoes in the morning, some of these guys, but they're crushing it and they're closing a lot of deals every month. So based on that, I believed I'm not a sales guy. I can't dunk a basketball. I can't drive a golf ball 400 yards. I can't make a beautiful painting. I'm not a sales guy. So, like I said, then I got into operations at title processing. Did that for close to a year. Made good friends with one of their mortgage clients. Went to process mortgages. So by now, I've probably been in the business 3 years, maybe 3 or 4 years. And that mortgage guy and I opened a title company. Had that for 5 or 6 years. I left that to go open a mortgage processing company. Somehow, through all of these sort of different places I've been at and different roles I've worked, I finally realized I don't need to sell anything to anybody. In other words, all I have to do, so if Paul comes to me for a mortgage, I'm just here to help Paul. I'm here to answer Paul's questions, explain how the process works, why does it have to be this way, why can't it be that way. And it was a bit of an eye-opener in the sense that my previous experience had been that sales was a an aggressive thing. You, like I said, you knock them on the head till they submit. And so that was really empowering in the sense that I realized, wait a minute, all I have to do is know what I'm talking about. And again, by now I've probably been in the business 10, 12 years.
Mm-hmm.
And so I eventually shifted from processing, had a processing company for a few years. I finally shifted from processing to actually originating. So back in a sales role, but it's night and day different than when I started because again, I don't have, if Paul doesn't want a mortgage, I'm not here to knock him to beat him into having a mortgage. So my role I'm realizing is really, it's not even so much sales. I'm here to facilitate the process and I'm here to advise you on the process. I don't need any slick sales ability or a good line of BS because I'm just here to help you and answer your questions and explain how it works. So that's, in a nutshell, that's been my experience. So it was there were certain parts of that journey that were pretty painful and humbling, but I think for my personality type, it's probably the only way that I could have actually had success in this business was to learn it from the inside out.
Sure. Yeah, I think in today's day and age, there's a big difference between being a salesman, a pitch man, or a problem solver.
That's exactly it.
So,
problem solving is and I'm glad you used that's a good term. There's a lot of loan officers who are what I call order takers, which is they'll get a call from Paul, hey, I want to buy a house, $300,000. I'm going to put 20% down. And most loan officers say, okay, Paul, here's your rates and fees and your pre-approval. Call me when you're under contract. And the reality is there's so much more that a loan officer should be doing for you. They should be advising you what's the best strategy to how do you structure your offer. Every buyer wants to pay less than every seller wants to receive. So as a loan officer from a truly advisory role, it's up to me to help strike that balance between how do we achieve what you want, whether it's payment and sales price, and how do we achieve what the seller wants, whether it's net proceeds or how quickly can we get to the closing table. So I've had a lot of success as the advisor role more than the order taker because, I'm active throughout the process. So I play offense to get the offer accepted just as much as the real estate agent does. So. Sure.
Yeah, that's pretty cool. So as the market's kind of shifted from the foreclosure days to now it's really screaming it at full speed. How are you able to help real estate investors? What kind of programs are out there? What's changed since, let's say, 12, 13, 14 to now?
Yeah, good question.
Yeah.
So like some of the folks said on the last podcast, I mean, it can be challenging to find an investment property on the MLS and still have it cash flow positive. In other words, obviously, the investor wants to buy for as cheap as possible to minimize any housing expense that they have aside from taxes and insurance. So they want to borrow as little as possible. At the same time, one of the big changes we've had in the past several years is back in the old days, let's say I have my home that I live in and I want to buy a property to rent out. Well, there was a time where I had to qualify for the new mortgage on the investment property. I had to be able to carry my own mortgage payment, taxes and insurance on the house I live in, and the housing expenses of the property I want to buy. Nowadays, there's a way that we can essentially utilize projected rental income from the property you will be buying to help offset those expenses.
So they don't necessarily need the reserves that they did 3 or 4 years back.
Not only just the reserves, we still need reserves on rentals, and that varies for how many rentals and this kind of thing. But the main thing is, from an income perspective or a debt ratio perspective, they don't need to be able to carry that full investment property housing payment because
Gotcha.
Because the presumption is, well, that's going to get rented out. That's the purpose of the purchase. So they let us apply projected rental income to offset that housing expense.
So you can essentially have a little bit higher DTI than what was previous.
Well, yeah. I mean, the DTI limits are still the same, but they let us apply projected rental income to offset the new housing expense, I guess is the way to put it.
Even if it's an empty property at that time.
Yeah, exactly.
Okay, if it's not in service yet. That makes sense.
Correct. Yeah. I mean, if that's a good point, Dylan. So if it's already tenanted, we just need to show that the lease will that the new owner will overtake the lease, and that's one way to do it. And if that's not the case, like you said, if it's vacant or if the tenant's going to leave, when the ownership changes, then we can just use projected rental income.
Okay. So, Paul, you do a lot of out-of-state investing, and you use the BRRRRR strategy. I always get confused, even though I've been in bigger pockets since the early days. But why don't you break down BRRR? It's 3 R's or 4?
Four
Four
R's.
R's. But break that down for us, and maybe you guys can talk a little bit about how that works.
Yeah, so mortgage brokers, banks are very important to the process. So the way BRRRR investing is buy, rehab, rent out, refinance, and then repeat. So 4 R's. The term was coined on Bigger Pockets. I think people had been doing it for a long time before then. But it's an extremely powerful process because if you got $90,000 and that's it, you can put $90,000 in a house. And if you buy right and rehab right, you can refinance almost all of the money back out of it. So some of my strategy there is making sure that the numbers work from cash flow perspective. So it's got to be able to pay the mortgage. But also when I buy, I want to make sure that I'm going to purchase plus rehab 75% of what the ARV will be, the after repair value. And if you do that right, you can pull a large majority or almost all of it out of the deal. So that's my strategy that I use right now. So let's talk about that a little bit. If I'm a new investor coming to you with that strategy. What are some of the terms that you guys or the products that you guys work with to be able to enable that kind of a process?
So that's a good question. So, for the most part, whether you walk into Chase, Bank of America, Fifth Third, Caliber Home Loans, any of the big players, if you will, anybody who's works with Fannie Mae and Freddie Mac products, they all pretty much have the same rules. Yeah. So like you said, Paul, the strategy of buy, rehab, rent, refinance to pull the cash back out, I see that's common with a lot of my clients. So to your point, you just have to make sure that you have a good handle on the post-rehab value so that you're not disappointed when you go to refinance and you can only pull out far less than you thought you could.
Right.
Now with that in mind, and I think you and I talked about this when we met a couple days ago, Paul, at the Macomb RIA meeting. Fannie and Freddie require that the title has to season for 6 months before you can pull the cash out.
Right.
There is an exception called delayed financing, where you can refinance up to 75% of the, not even of the, well, I suppose they presumably should be even, but of what you paid for the property.
Yeah. So Tia and I were just talking about that within the seasoning period, right?
Yeah. So without having to wait 6 months, you can do that. Now, we of course have to be able to document where the funds came from. So if you got money, if you and a partner went in, we just have to essentially separate whose money was whose, or you may both have to be on the loan to pull it out. But but that's absolutely doable, if you will.
Right.
Beyond that, there are some lenders that don't require the 6 month seasoning before a cash out on a rental property. Yeah. Typically, those are going to be what they call portfolio products. Yeah. Which is, so let's say I'm going to make this up. Let's say 123 Mortgage Company. They might be able to do that without the 6 month waiting period. But when we say it's a portfolio product, what that means is they're going to hold the note. They're going to hold the debt themselves. Yeah. They're not going to sell it on a secondary market to all these, Wells Fargo, Mr. Cooper, the Fannie Freddie players. And so, of course, the price for that is you're typically going to pay a premium on the interest rate. Yeah. And again, the thought process is, well, we're the only players in town that will do this for you. If you don't want to wait 6 months, this is the cost to you.
Right. So Tio and I literally were just having that exact conversation because he's got a guy that he sent me to that said he could do it next day, right? So, I asked him, well, what kind of interest rates and terms? He's like, well, I don't know about that. So I was imagining, I was imagining that, the rates were going to be a little bit higher. So the seasoning period, that's a real challenge for the BRRRR process. So I want to talk a little bit about, and I don't want to hijack things, so you stop me, Dylan, but I want to talk a little bit about, trying to find a way to shorten that. So, let's say I want to go in and buy a property and I've got, $120,000 in cash, right? So I'm buying it for 90 and I'm going to rehab it for 30.
Okay.
is there a way that on the HUD, during closing, I can put that $30,000 into an escrow account, and I can pay they'll distribute the cash to the seller. And so on the HUD, if I were to go to a traditional bank and say, hey, I paid $130 for this property, now I want to do a cash out refinance. Is there a trick or a strategy that can be done there with the way that you title and you escrow money? Because I've heard through some, bigger pockets and others that there's some kind of a strategy that they can. Now, I don't have that kind of capital to just put it all in like that.
Sure.
But my goal is to try to find a strategy where I can do these cash out refinances faster.
Sure.
Because then I can move my money faster.
Sure,
right?
sure. Yeah, and if I'm understanding your question correctly, not really. Not that I'm aware of anyway.
Okay.
In other words, the limiting factor, if you want to call it that, on the delayed financing exception is that you can only refinance up to the sales price.
Yeah.
So if the sales price was 90, that's and you can take out 75% of that, right?
Right.
So, and listen, even if, let's say you buy it on January the 1st, right? And let's say that by April the 1st, you bought it at 90. Let's say by April the 1st, you're done. And that thing you might even have an appraisal at 120 on it.
Mm-hmm.
Because you're within that 6 months, nobody cares about that appraisal.
Right.
You're limited to the initial sales price.
Mm-hmm.
So the only way to avoid that, it's almost, I guess, one or the other is the answer to the question, right?
Right.
You can pull out money within the 6 months, but you're going to be limited to the sales price, regardless of what you put in. Even if you put that extra 30 for the rehab and escrow, that's not into the transaction in the sense that it wasn't part of the sales price, right?
Okay.
It might be into your investment, but not the actual purchase of the property.
Right. Okay.
So within the first 6 months, you're limited to 75% of the sales price. After the 6 months, so if you want to go on June the 2nd, let's say, right?
Yeah.
Then now if it appraises for 125, you can take out 75% of the 125 or 120, whatever that number is.
Yep. Okay. Got it.
Yeah, but on that scenario, couldn't you just? I mean, you're going to end up paying more in fees, but take the refinance at the purchase time, 6 to 9 months later, once you're up and rented, or even wait a little longer, because right now you're also gambling that rates are, and you're going to have the same terms in 6 to 9 months.
And values, you could see values drop too.
Yeah,
Great point.
Yeah, where if you purchase it, finance it, pull your equity out, at least maybe you're not getting the 120, but you're getting the 90 back, or 75% of the 90 that you can deploy into other opportunities.
Correct.
And it's not going to be the best win, but it's still. And then you just look at that spread as the cost of doing business.
That's exactly it. And it's, I suppose it's one of these things where how badly do you need the money? And can you settle with 75% of 90? Or do you want to, like to your point about who knows what's going to happen with rates and values, you could sort of take the money and run now at 75% of the sales price of 90, or you can let it ride and then, presumably, once the rehab is done, appraisal after 6 months, and then take out 75% of 120.
And I'm sure you'd love to write a second mortgage also. So.
I'm here to help. I'm here to help. But no, and again, back to the whole advisory role, I guess, that I see myself as, I deal with this with clients all the time, and it's, Brian, should I take the money out now? I don't know. How badly do you need it? Can you, is this do you have something lined up? Is it a sure thing, or do you just want the warm and fuzzies of having the pile of money before rates may go up and values may go down? So it's on a case by case basis, and we kind of navigate that together, right?
Yeah. So in my strategy, so far it seems like I've got to wait the seasoning period, because in my strategy, my goal is to eventually get to the point where I buy and rehab right enough where I can pull 100% of the cash that's in it, even if I'm using a hard money lender to initially rehab it, right?
Sure.
I want to be able to cash them out, and what I get back out of that is going to pay them off and the fees and whatever that's in the transaction. So that's kind of been my quest. And every house I get to, I leave smaller and smaller amounts of money in the deal, which
Correct.
The cash on cash goes higher and higher, right? So that's my ultimate goal. And if I could figure out a way with maybe a portfolio lender, I may be willing to pay 6, 7, 8% if I could pull it out.
Yeah. You're probably going to, I'm shooting from the hip here, probably 7, 8, 9, 10%.
Yeah.
But to your point, that's in what Frank said.
30-year AM, no balloon.
Correct. And so back to your point, Frank, everybody loves to tell their neighbor what a sexy interest rate they have, right? I'm at 4 1/8, whatever. The reality is, it's whether it's you and your neighbor and your primary homes, the interest rate it's a function of the snapshot of the market and the circumstances when you bought your house, right?
Yeah.
They might have bought at a time when the market was higher. You might have bought when it was lower. At the same time, on an investment property, again, everybody loves the idea of telling their buddies how low their rate is, but the fact is, nobody knows the underlying circumstances behind that. So, in other words, yes, you might be paying through the nose on a portfolio product, but did you get your money? Yes. So, is that the cost of business to get the money out before maybe having to wait until it's seasoned 6 months? Sure.
Yeah. Well, my thought is I'll pay 8% if it's going to cash flow $200, $300 a month,
Yep.
right? And I've left $0 in the deal. $300 a month on a $0 investment, just my time. That's 100%. That's an infinite amount cash on cash ROI, right?
Mhm.
It's like driving down, the street, finding a fully rehabbed property, and somebody giving it to you.
Frank, what's your take on that from a traditional finance standpoint?
I mean, from the finance standpoint, it's really just how much you have in there and how you can really maximize that investment. I mean, 10% sounds like a bad rate, but
However,
if it works into a good deal,
sure, if you bought the house for $10,000, it doesn't matter what the rate is.
Yeah, and it's like you're saying, everybody likes to talk about your personal residence, and I know 10 years ago you had the investors, but then you had everyone else out refinancing their own homes and talking about how low their payment was and how their interest rates, and didn't even know what any of that meant. And really, it's, can you deploy those assets into other income producing assets as opposed to
That's it.
go
Yeah,
buy a boat,
exactly.
a Corvette, and stuff
Sure.
like that we put us into what we got into. So,
Yeah.
but I think what you're saying really, and then it's taking your money out, and it's really that cash flow of that life cycle.
Mhm.
And then it's really the evolution of that real estate investing career, getting into a new opportunity, or how you're going to really structure that, because at that point you have no equity in. And now if you strategize, you can effectively never pay tax on that transaction
Exactly.
through to the date of your death.
Exactly. Keeping my money moving, right? And unfortunately, the banks that have this 6-month seasoning where they're, they've got a cadence that, they're slowing you down on how fast you can move your money.
Sure.
Right?
Yeah. And a lot of it is, the banks don't want you out buying 10 properties, at least without that track record.
Right.
But as you're building in that track record, there's opportunities for larger deals or to attract other outside investors.
Yeah.
Or, I mean, effectively, you could structure a deal that you don't put a penny of your own money in,
Mm-hmm.
and have outside investors. And it's really with these smaller deals showing that return that you have there.
Yeah.
So.
Well, I got to tell you something. This is high level stuff because all I'm good at is making posts on Facebook and running real estate groups. So I'm here with 3 guys way smarter than me. And really, that's what this group's all about. It's about bringing value and kind of learning through real life experience on how these situations can help you guys buy and sell real estate and maybe invest before or in different ways that you didn't know possible. So I guess next question for Brian is where do you see, and even Frank too, I want to hear from you guys. You guys are a little bit more on the serious finance side. Where do you guys see the economy going over the next maybe let's just say year until the new election comes?
I'll defer to Frank on this.
Oh, I mean, right now, things seem to be trekking along, and I think there's a lot of just political uncertainty and love or hate politics. Right now, we have a real estate friendly administration in place, and can that all change? And after the new election, yes, things can change. Can it change it drastically? Not necessarily, but things can change and not be as favorable. Some of the overall economy, which would trickle through to interest rates, which is going to impact the values of the real estate and different cap rates. And so it could have an indirect impact from other standpoints. Right now, we're in a great real estate administration that's real estate friendly, and a lot of the opportunities they have in place, and it really just depends. So I don't really foresee much happening. I think there's a lot of dissatisfaction in the whole political landscape out there, and people are just kind of sitting tight. So, I think the state of Michigan's gone to a Democratic governor, which has changed some and some of the outlooks. So I think we're kind of in a holding pattern at this point.
Yeah, I agree with that. I think what you want newer real estate investors to understand is that when rates go up, typically values come down a little bit because people can't afford. We're not talking about investors. We're talking about the homeowners. So if you're going to buy that $400,000 home and rates are 4 and they go up to 5, you can't afford that anymore.
Yeah, it's a big difference.
It changes huge. And for those of us, I mean, Frank's the same age as me, so he was around during the foreclosure boom, but he wasn't fully focused in real estate, I don't believe, like I was, or Brian was in real estate at the time.
I was focused on just keeping my lights on at home.
Yeah, right. So we know what it was like. I mean, it was utter chaos and destruction.
Oh, yeah.
So it's not going to get back there because the foreclosure days, with all of the arms resetting and all that crazy stuff. And again, you said fog the mirror mortgages. One of you guys said that.
Yeah.
It's a lot tougher, even though it's gotten easier the last 4 or 5 years. I do know that, but it's a lot tougher to get financing than it was way back in 05, 04.
But like during that period, you had a lot of builders and developers that could develop any vacant tract of land, and anybody that for $300 a month could be in a $400,000
Sure. Yeah, with a negative AM mortgage.
Yeah, with all the mortgage products that were out there, and mortgage people were saying refinance every 6 months, and we're going to be out there, and those products have really gone away, which closed up a lot of the development and a lot of the building businesses, and there's
a lot more cash backing those deals now.
Yeah, and maybe a little more ethics or things out there out in the marketplace these days.
Yeah, the appraisals are all different. We just had John Manzo at the RIA talking about that, and with appraisal management companies, I mean, things have changed so much. John, you don't know John Manzo, do you?
Yeah. Well, I mean, just I've known the name. And,
yeah,
I met him at the RIA meeting.
Oh, you were there, right? Sorry. So John's been around 25 years, and he was there before the foreclosure boom, during and after. And he was talking about he could get 3 appraisals done himself each day. Not necessarily taking the pictures and going out and measuring them, but doing all the processing back at the home office. Now it's 1 for a day and a half because they're so much stricter, which is good because it just means it's going to be a lot tougher for people to go into foreclosure. We don't want that to happen as investors. Everybody talks about the good old days. We were literally shooting fish in a barrel and just buying properties. I mean, I offered 40 cents on the dollar on thousands of properties a month back in the old days. You know, we were making 100 offers a day. And I didn't look at a house unless we got a counter offer, and it started at 40% of ask. So it was nuts. So it's probably never going to get like that again. But I think it's good for us to be poised as investors just to make sure that we are being conservative. You know, Paul's being conservative. He's buying stuff that's cash flowing. So can he get hurt? Maybe, but rents go down a little bit. Even in the bad days, rents to go down like $200 a month on a $900 rent. Most of them didn't go down 2. They went down 1. So you were still okay. It still serviced the debt.
But the rents today are higher than they were on those same properties 10
astronomical.
Years ago.
Yeah, you can get properties outside the city of Detroit, in lower Macomb and Oakland County, in the $30,000 to $50,000 range, and earn $900 a month all day long.
Oh yeah,
that's huge. We never had that opportunity before.
Something that was interesting that John said during the RIA is that the owners of properties today, you know, investors as well as primary residence owners, the base ownership is a lot more qualified for the properties that they own, right? And I think during the foreclosure crisis, what really, once you started picking at the thread, right, just like a cheap rug, it just came because, you know, as the rates went up and these individuals that weren't qualified to be in the homes that they were in, it just all like a house of cards. So I agree with John, and the feedback that I've heard from other people is that it unlikely will get to that point because so many people are in homes today.
Won't let it because it hasn't let it get there.
Well, yeah, and I mean,
that false base hasn't been rebuilt.
Well, yeah, exactly. And so many of those products that, I mean, there were a lot of things that contributed to the crash, right, in 07, 8, 9. But I mean, back then you could have a house. You could have a house that's worth $100,000, and they'll give you a loan for $125,000. You know, I mean, you're it's literally like upside down the day you
LTV,
close.
Right?
Do you guys remember the 40-year interest only that popped up right before everything?
Yep.
I saw that. I was like, good God, I've never seen anything like that.
Right. And I mean, Frank's a CPA. He's a finance expert, especially at this table. So when he's laughing, it tells you how scary it is that a product is out there that a normal homeowner can literally light a wick to a bomb and set it on their kitchen table and just hope that it blows out. And that's what they set us up for. That's why it won't happen
Good
again.
analogy.
Yeah.
It won't happen again. They won't let that happen. I mean, not in the near future.
Although as an investor, I wish I was around back then.
Absolutely.
To get 110
Absolutely.
LTV, right?
Just putting money.
You know,
It was
on a cash flowing property. If the numbers work, 110 LTV, I could pull all that cash back
Sure.
out, and even
do it
if
again
the
and
cash,
again and again and
if
again.
that cash flows is $200, it is still a great deal, right?
Sure. Great deal for you. But then if, when the house of cards collapses, the bank stops holding the bag and they say,
Right.
wait a minute, we are owed, another 10 grand on this property versus what it's actually worth.
Right.
And of course we have legal fees, all this jazz, right?
Right. Exactly. Yeah. If when those foreclosures, there was no equity left, right?
Correct.
Yeah.
There was no financing. I
Right.
mean, it was so tough to get a mortgage back then. To get a property, I remember I had a property in a good part of Macomb County, and it was a 3,000 square foot, big old 70s colonial. Probably sold for $280. It was in the Fraser School District in the old days, maybe $300 pre-crash. So say 2004. In 2009, I sold that on a mortgage for like $189. That was with granite and new bathrooms.
Sure, I believe it.
For 3,000 square feet at 16 in Garfield, which, I'm kind of boxing us in here. We are a local show, but I mean that's crazy. Today, that's going to be $100 a square foot again,
Yeah.
Yep.
or close to it, anyways.
Yeah.
So, I think we still got a little bit of time, but I think maybe in the next 2 minutes for each of us, why don't you guys tell us what maybe your short-term goal is over the next year or so in business, maybe what you're working on now, something kind of exciting that's happening, and just to get the watchers and listeners here to learn a little bit about yourself and your own business personality.
Want me to start?
Sure.
Okay. So, number one, I am currently looking for partners, money partners to go in. The limiting factor for me right now, I've got a huge stream of deals and I don't have the capital to close on them, right? So really looking for people to partner with me. I'm closing on a duplex next week. This is the first purchase with a hard money lender. So I'm closing on that duplex. And, here in the fall, I bought several of them this spring. And so now I'm just waiting for that seasoning.
Right. Sure.
And I'm going to probably do 3 or 4 closings this fall as all of those come available,
Sure.
With the seasoning. And then I'm probably going to, sock that capital into, an account and then get ready to go get it again next year. So, and my goal is 31 doors. So that's my kind of my freedom number to get to.
We're going to go around the table.
Frank?
Right now, just looking to provide myself as a resource to everybody in the group, along with network, and in the next 6 months to a year, looking to get more involved on the active side myself, and just become more of part of the group.
So Frank, Frank's very humble, by the way. I know that Lori, your wife, you guys have a bookkeeping service. I don't know anything about it.
Oh.
But why don't you tell us what it is, what you guys offer, and how it works?
Oh, so my wife's actually a bookkeeper and works with different investors and management companies from the day-to-day QuickBooks management side of things, and all the way through. She has a few commercial properties that she's actually dealing with the individual tenants, and one of her newer clients actually had missed some lease escalations over time, and she was able to quantify that, and really
Value add, huge.
Rent had never changed since '98. Come to find out, and
What's wrong with that if you're the tenant?
and
Right, exactly.
Well, then when she quantified it and was able to provide it to her client, it was, I think it was $260,000 of missed rent. So they're actually going through the process, and there was some estate issues and different things with this company. So it was really drilling down to more than just the balanced banking, and what she's able to identify. A lot of small owners don't necessarily need the day-to-day CPA and services, and it's really just that more hand-holding the accounting and that type of service. So been able to do that, but and I'm always looking to talk to investors. I get questions on what would be the best strategy for them and how do they structure. It really depends. A single person with no family compared to a person with a family starting out to older, what are you going to do? How are you going to structure? What are you going to do with the tax recapture on when you've taken out your equity? Or are you going to flip into more of a passive investment when you go off into the sunset? What's your real long-term plans? And I hear a lot of short-term planning, and it might be beyond where somebody's thinking, but at least getting those wheels out there that they know. Because I actually got a call from a client that 48-year-old son had a heart attack, passed away, had no will, and I actually had a family member pass away this year, and there was a home tied up with a few other siblings, and there was no will, trust, or anything. I tend to kind of stay out of my family situations, and that's a situation. There was no will. It's a home that's going to have to be probated
Sure.
for these other family members,
Sure.
because nobody talked and planned.
Yeah, we're going to dig really deep. David Sobel, our resident genius attorney, as I like to call him, I'm going to get him and Frank on here, and I'm going to hold them both down because I'm bigger. I'm not much bigger than Sobel, but I think I got a few pounds. I'm going to hold them both down, and we're going to get really in the weeds with some of this advanced strategy stuff and the probate, how that's affected from the finance side and the legal side, and just some other some really high level stuff. So pretty soon we'll definitely get into that.
Okay.
Because the value that Frank adds to this group is huge. Like I said, he's very humble. So, Mr. Mutter.
So,
You can do
goals, right, for the next year?
Yeah, in your radio voice, please.
Well, my goals. No, it would be exhausting, at least for me, to do the whole show like that. So you'll have to wait till we're off air. Right.
With the towel.
No, so and Frank just said kind of like the crux of my mission, if you want to call it that, is the education piece, right? So in the general sense, I've kind of two goals here, right? In the general sense, it's when I started back originating mortgages and dealing with buyers. I mean, right away, it's apparent to me that not even just for first-time buyers, of course, but I was surprised how many clients that I'd meet with. This was, let's say, their third home they're buying, and it's their sixth mortgage because they've refinanced in the past. And it blew me away how many of these folks still don't understand anything about their numbers at the closing. Why do I have to bring this much? Well, you told me I had to bring in, I'm putting down 10%. The house is worth $300,000 is what I'm paying for it. Why do I have to bring in $37,000? 10%. So, and all the way down to what's my escrow account? Yeah, I've seen this in the past. Why do you guys take this money up front? So it just made me realize there's a huge need for education, not just for my direct clients, if you will, the people borrowing the money to buy the house, but so most of those clients come to me because they're referred from real estate agents. So on the professional side, I guess you'd call it, I'm finding a lot of realtors either don't understand or maybe just don't value the role of a good loan officer for their client. I said before, I used the order taker analogy. That's kind of like the bare minimum, if you will, right? But a mortgage isn't exactly, it's not a commodity. It's not like the store brand Lucky Charms is the same as the Lucky Charms that are $6 a box. A good loan officer should be an equal partner in getting the offer structured, getting the offer accepted, and then obviously providing a smooth mortgage and closing experience. So back to the question, one of my missions for this year is to just keep on educating on the professional side, the realtors, the importance of a loan officer who knows what he's doing. It's not, a mortgage isn't a punch list item when you're working with the buyer for the house.
No, your mortgage lender is a partner on the deal with you.
Well, and you'd be surprised how many realtors, like I said, either don't understand or don't value that. It's not uncommon for a realtor to say, "Oh, Brian, I just got a new buyer, but he's already been pre-approved, and I didn't want to rock the boat." And that's completely fine. And listen, maybe he's pre-approved with his uncle, who's a mortgage guy, or the guy who's done his last 6 mortgages and he's comfortable. That's fine. But we run into this all the time where the realtors just say, "Well, he's pre-approved. We have a deal closing next week." The client came to me, "Hey, Brian, I'm pre-approved. I'm under contract to close on May the 2nd, but now I'm shopping rates and fees. What can you do for me?" We go through the whole back and forth, literally probably 10 conversations we had. We skin the cat 50 different ways. What if we put down 3%? What if we put down 20%? What if we have it in my wife's name only? My wife and I, we skin the cat a million different ways. And at one point I said to the client, I said, "Hey, whether it's me the other guy you're talking to or the third guy, it doesn't make a difference. This is not a pressure thing. You need to get going on this. Whoever you want to do business with, you need to make a decision, because right now you're out ahead of your contract closing date. You're fine. But if you waste any more time, your back's going to be up against the wall. About 10 days later, he got back to me and said, okay, Brian, I'm going to send you all my paperwork, and we're going to do the deal with you. Well, paperwork starts coming in, and I'm looking at he's a self-employed, it's a married couple, the husband's self-employed. His tax returns are not showing me the income that he's telling me on the phone. So at one point I said to him, and I said, listen, I don't see a way that we're going to get this done without you having to first sell your house. I don't want to get in the weeds too much, but basically he had been told by whoever pre-approved him in the first place, tell you what, you can go ahead and buy the new home without having to first sell the old home. You can swing both payments is what it amounts to. Based on the paperwork that I start receiving, it doesn't look that way at all. So I said to the buyer, I said, listen, me and the other guy, we all have the same rules. Our banks, the loan has to fit in the same box. So maybe he saw something that I didn't, but based on what I'm looking at, I don't see how you can buy the new house. You got to sell the old one first. And then I said, did he look at these same tax returns, the other loan officer that pre-approved you? Oh, no, he didn't look at them. We just took this was based on a phone call, based on a conversation over the phone. Famous last words. I mean, it's the kiss of death. So back to the education piece. Again, it's, I'm sure that his realtor heard, hey, he's pre-approved. That's fine. He's got a lender. It's not all lenders are created equal, I guess, is the best way to put it. So there's a lot of education to be done on the professional side about what a good loan officer should be doing for you and for your client. I
run into that all the time, where that self-employed individual, where they're self-employed, has a business, they get their tax return, they have an LLC, might be a single member. Well, where's the tax return for this? They don't even understand disregarded entities. They don't understand K1s. Correct. They don't understand Schedule C, E, what it is. Then they're saying, well, just have your CPA write a letter saying that, you're self-employed and you made this much. And I'm not vouching for anything Correct. That somebody makes. I'll say, under my understanding, you're in this business and that's what you made last year. I can't guarantee your stream of income. Well, and it's hard for them. And I think having a company such as yours, as opposed to some of the large machines out there online, whatever it may be, you can touch that customer as opposed to going through departments.
Well, yeah, not only that, and it's funny you mentioned that, Frank. Yeah, so self-employed borrowers are a potential can of worms. Let's just put it that way. If I get a client who comes to me and says, I want to buy a house, we start talking about his income, I make $100,000 on a W-2 at GM, and I have a car payment. That's it. That's pretty much a lay down deal, right? I mean, it's almost a no-brainer. When you get these guys who are self-employed, I can't count on three hands the number of clients I've worked with. They tell me their income is X, and their tax returns show me, X divided by 4, right? So there's always this disconnect between the lifestyle that a self-employed person might maintain, and they might feel like they're earning $80,000 a year, let's say, but there's a disconnect because listen, when you're applying for a mortgage, the underwriter and you're self-employed, there's one story that tells your income. That's your federal tax return. It doesn't matter if oh, well, Brian, I made 80 last year, but my accountant's really good. He got me down to 16. Well, guess what you make?
Or it's all cash.
You make 16. Exactly. Or it's all cash. Exactly. So again, it's just a lot of education to be done on that. Like you said, Dylan, a good loan officer is a partner in getting the deal done. A lot of buyers, and through no fault of their own, most people buy homes a few times in their lifetime. Investors obviously, hopefully, are buying and selling more frequently and in higher numbers, but for the most part, the buyer kind of can't be blamed for that, right? It's our job as the professionals to educate them about how can't we, why this, why not that. But at the same time, as a professional, so the real estate agent, they really should have a better understanding that the process doesn't go real estate agent, find house, get under contract, then mortgage guy comes in and the real estate person falls up. It's not a baton we hand off. We should be working together from the very beginning of meeting with the client, even, so that we can ensure the whole process goes smoothly with no hiccups, right? But a lot of people have yet to be taught.
And I think a lot of that goes to people wanting to understand one thing, or it's easy to, I have a house, I can live off cash, I can buy all the toys and stuff. But what happens when you want to buy that new house, or
Precisely,
or you get someone, well, I haven't reported this in so long, but I want to start real estate investing, and well, you've got to establish this, repair your credit. These are all things that if somebody ventures into real estate investing, unless they gets rid of a W-2 job, but now you're going to need a person such as yourself that'll take that income into account because they don't have that.
Exactly.
But then someone that, well, I do a lot of cash work and I don't report it. I hear that from people sometimes. And from a tax standpoint, I can't even take them on as a client. If you tell me you made X, but you're only showing me this, I can't even look at a tax return that you're going to grossly understate your income.
Exactly.
Don't tell me that. But
exactly.
On the other side, when you want a mortgage, I'm not going to write a letter saying you made $200,000 and you only reported 50.
Well, exactly, and it's not a good look for you. And again, at the same time, there's one standard by which a mortgage underwriter is going to conclude how much self-employment income you made last year, and that's your federal 1040. That's it. You know what I mean?
Well, on the other side, it's if I write the letter now
you're on the hook.
I'm on the hook, for colluding to federally defraud a federally insured financial.
It'll be fine, Frank. It'll be fine.
Yeah. My realtor told me. Yeah, my mortgage guy said just write the letter. I hear that.
Right. Sure.
Wow, that's pretty amazing. So we're slowly wrapping it up here, and I just want to go around the table and kind of do a little brag for each one of these guys. So we've got the peanut galleries making jokes over there, and I'm not afraid to go off camera and talk about that. But so Paul does a lot of out-of-state investing. He does buy and holds. He actually has a kind of an Airbnb wing also. So he's looking for private lenders. He's looking for kind of deal partners. Frank is a CPA, and he is looking for other investors like us to possibly do CPA work for. And he and his wife own a bookkeeping company. So those are a couple.
She does.
She's the boss. We know that. They all know that. So Brian's a quote unquote mortgage guy, but if you're looking for financing for investment properties, your personal home, or if you just need questions answered, I mean, you just heard him go off for 20 minutes about how important it is to actually understand how mortgages work.
There are no short answers with me, Dylan. I apologize.
Right. We see that. So he's going to get his own podcast soon, but, yeah, so that's what each one of these guys do. And me personally, all I'm looking to do is to build the group. I'm wholesaling right now, doing a lot of buys and sells. So if there's anybody out there who is looking for help, or if they find a deal they don't know what to do with, you guys can always come to me, and I'm more than happy to lend a hand, and maybe we can do a deal together. So I think with that, if you guys want to give out your contact information quick for those who are listening.
Oh, my wife already gave it out.
Okay.
248-705-8640. I'm on the group, so feel free to reach out to me, and I want to be a helper, free information out there, so feel free to contact me.
Frank Alcini, 586-805-1040.
1040. Isn't that funny?
Did you have to choose that?
He picked it.
Is
that
on?
Oh, he got it.
That's
nice.
good. That's good. I should change mine to 1003. The little application. But wait on. So my name is Brian Mutter. You can call me at 248-956-0445. And again, I'm happy to help with whatever I can. I deal with a lot of investors who sort of back to this hand-holding from the inception of the I want to buy a house decision. I'm happy to send them out. They can send me properties they want to look at. I can send them cash flow analyses, kick the tires, however I can help.
All right, and I'm Dylan Tanaka. You guys all know where you can find me. You can find me on Facebook. I've got 5,000 friends, unfortunately, so you can go to thedylantanaka.com and follow me, or you find me here on the group. And with that, we will see you on another Roundtable podcast soon.
You've been listening to the Michigan Real Estate Investor Network podcast. Just call it the network. To subscribe to the show, go to www.michiganreinetwork.com, where you can have the show sent right to your inbox. Subscribe on iTunes or your favorite podcast app. If you'd like to be on a future show, there's a link on the site to submit your info. The network is 100% focused on the Michigan real estate investing community. Whether you are brand new or a grizzled vet, we want you to be a part and share the love.